Hello, my name is Steve Bigelow with the Candlestick Forum. We often get asked, how do you prepare, or how are you prepared for when reversals are about to occur, even though they haven't occurred yet? And that's very simple. There's easy indicators that can be used using candlestick analysis. One, the bigger the signal, creating maybe a double bottom, tells you you're in an uptrend. We have the key line indicator that is very effective for indicating what's going on in investor sentiment. Note what was happening up here. Yesterday, we had a shooting star signal up here in the overbought area. Today, when they gapped it up again and traded up strong, where was it? That far away from the T-line. Basic T-line rule. The further away you move from the T-line, the higher the probabilities it's going to come back and test it, which means when you start seeing reversal signals up here, you can be prepared to start taking profits on individual stock positions that are starting to show weakness. Also, you don't use just one index. Even though the Dow was trading up 300, 400, 500 points today, the NASDAQ had shown us an alert yesterday. Notice how it opened here at the low or the open of the previous day's trading and closed down there. That's a very strong indication there's been a change of investor sentiment. On top of that, when they opened it lower and started trading it lower today, we knew we probably had a bearish flutter kicker signal in progress, one of your strongest reversal signals. So if the NASDAQ was trading as a bearish flutter kicker signal, and the Dow was starting to show indecisive trading away from the T-line, that was a pretty strong alert to start taking profits on positions that were starting to sell off. Additionally, the S&P 500 was showing sell signals right at a level that everybody was watching, the 50-day moving average in the overbought area, showing weakness. The next indicator is basically your biggies, like Amazon. Notice when it opened lower what it was creating, a bearish flutter kicker signal. Going into earnings this afternoon, that was a strong indication that people were not real confident that the earnings were going to be create a bullish move. That's an indication that people that know what's going on are getting out. That's a good time to start getting out and or going short. So if we know the market was rolling over, that allows us to take advantage of signals and patterns. Again, the bigger the signal, the more compelling there's been a change of investor sentiment. Now you could probably be going short on this one again, because look at your bearish engulfing signal. When they failed to get up above the T-line, where do you think your next likely target's going to be? Down here. So if the market is trading off weaker tomorrow, this becomes a good short, and it might even be a good spread, put spread. This is another major advantage of candlestick analysis. It allows you to identify the strong sell signals, like your bearish best friend, and then if the market is trading weaker, it kind of enhances that probabilities are still heading lower. This is what gives you a lot more confidence that if you're shorting the stock or buying puts or buying put spreads, at least you know you have the probabilities going in your favor, and now you have the opportunity to figure out what is the best way to profit from identifying that price move. So when we see something like this, this is what we call observe the obvious. You're in the overbought area. You're seeing a bearish engulfing signal, failure at the 50. That tells you get ready to close out the position and go short on weakness. Again, the additional confirmation would be seeing what other stocks in that same sector are doing. You can see Micron sold off hard today. So if it can be identified that a sector is being sold off and you can see which signals are producing the highest probability trades, they're the ones you want to go after. Conversely, if you see the bullish patterns, INMD reported strong earnings today, confirming the J-hook pattern. And what's even more compelling is a J-hook pattern that breaks out through a level that everybody's watching, where it first fails. This is called a bobble breakout. You can see it's a J-hook pattern, but it's making taking the effect of a resistance level, a support level, which is usually the T line, and then a high probability result that if they come back up through that resistance level, that J-hook pattern is in progress. And the reason that's even a little bit more compelling than just a regular J-hook pattern is we can see on a J-hook pattern that it usually supports at the T line and heads up. This one tells us everybody else is watching the resistance. We can see the support at the T line, and now our probabilities are that much greater than when everybody else sees that it's not resisting at the 200. They're piling in, making the probabilities of this trade that much stronger. Again, it allows us to make decisions as far as what is the best way to take advantage of the knowledge we have of what strong price moves are likely to occur. So that's what we're going to be doing Saturday. Come join us. This is a full day training on which option strategies are the best for specific candlestick signals and patterns. Essentially, you're putting all your stars in alignment. If you can identify the direction of the overall market and identify which sectors are the strongest, and then identify which stocks are the strongest in that sector, now you want to take advantage of that information and figure out whether you should be buying calls or put spreads, or credit spreads, depending on the time frame you have before expiration. It's not difficult process. It's just putting all the common sense into alignment. That'll be it. We'll see you in the chat rooms.